The time has finally come for me to talk about my newest addition to the portfolio, QQQI. Most of us know that covered call ETFs usually come with trade-offs, but this one has most of those weaknesses covered. And I even waited to get my tax forms before making this video because I wanted to confirm the tax-friendly nature with my own eyes. And it didn't just meet the high expectations I had going in, it shattered them. To the point where I will never pay taxes on most of these dividends. We're going to get into all of that, plus a few surprises that you probably aren't expecting. If you're new to the channel, welcome. My name's Jeff Teeples, and here we aim to grow your wealth with simple, time-tested solutions. If you enjoy these videos, then do me a huge favor and passively invest in that like button, subscribe if you haven't already, and consider joining the channel membership. It keeps the content flowing. You know what time it is. Let's grow. Why QQQI? Covered call ETFs come with their own set of complications. And when I first started researching them a few years ago, I had one hard requirement. The underlying index had to be rock solid. Otherwise, NAV erosion takes over. It reminds me a lot of watching out for yield traps in the dividend stock world. My two favorite indices have long been the S&P 500, of course, and the NASDAQ 100. They both have decades of stable performance behind them. Stock picking, or even actively managed ETFs based on a manager's gut decisions, can create disastrous results when you combine that with a covered call strategy. And after digging into a variety of these funds, I decided to roll with the NASDAQ 100 index for my covered call ETFs. And you're probably thinking, wait, Jeff, you literally just said that you want stability, and the S&P 500 is objectively more stable, the ride, the ups and downs, than the NASDAQ 100. And that's true, but with a twist. The higher volatility actually helps the covered call ETFs. That higher VIX creates a richer options market. The NASDAQ 100 has the perfect combination of higher volatility from its growth-heavy structure combined with incredible long-term total returns. And it has crushed the S&P 500 since inception. And I've showed this chart before on the channel, but check it out. I've been tracking my two favorite indices for quite some time now on this spreadsheet. And you can see here, this pinkish one is the NASDAQ 100. And I had to find data before 2000, and I've been able to use QQQ directly since 2000. And the blue one here is the S&P 500. And same concept, plenty of information out there on both. So I found the older ones myself. And then I've just been using SPY directly since 2000. But in our scenario here, I had a starting balance of 10,000 for each just to have something in there. And then we put in 6,000 per year. So it's as if you're putting in 500 a month. I figured that was pretty standard and like a fun, realistic scenario to track these things. But you can see here on the green is the difference, and it's from QQQ's perspective. So this negative number means that the S&P 500 outperformed, and you can see it did by quite a bit here in the first year. And you go down the years. QQQM caught it after 5 or 6 years here in 1991. Here in this video, we don't need to get too in the weeds. When we go all the way down with that simple dollar cost average of 6K a year, 500 a month, QQQ has ended after 39 or 40 years with 7.5 million more dollars than the S&P 500. You can see your ending balance with consistency and never panic selling with QQQ is about 11.6 million. To the S&P 500's 4.1 million, and that's through 2025. I update these annually. Back when I first started looking at covered call ETFs, JEPQ was the only kid on the block that really made sense for me. It did use the NASDAQ 100, which I liked, although with a manager's touch on the weightings and a more complicated option strategy based around ELNs. And another major downside was that most of the dividends were taxed as non-qualified at my ordinary income rate. Then QQQI entered my world and changed everything. Higher yield, more consistent dividends, better mirroring of the underlying index, a simple, transparent covered call strategy. And the silver lining, which we'll dive into next, is that the dividends are nearly tax-free. With the high-level basics covered, let's get into this thing. QQQI Overview. We'll start with what I find to be the most important aspect of any ETF, the underlying holdings. QQQI holds the NASDAQ 100 directly, just like you'll find with QQQ. No manager's decisions or active bets, just the rules-based index itself. And I popped out to Seeking Alpha here real quickly. And as I always mention, Seeking Alpha is the best tool to research stocks and ETFs. I've used it for years, well before my YouTube. I do have a link pinned in the comment below on Seeking Alpha Premium, and you can try it for free. So check it out if you're interested. But out on the summary tab, and this one hurts, I will say, covered call ETFs tend to have higher expense ratios because they're more actively managed. And ironically, with QQQI being more passively managed in nature, like per its methodology, it comes with a very high 68 basis points expense ratio. And that does, as many longtime viewers know, that breaks my hard rule of 50 basis points for something I own. But the tax-free nature makes it worth it. And we'll get more into that later in the video. But it does come at a sky-high 68 basis points. And its competition, JEPQ and GPIQ, which I also like from Goldman Sachs, come in at about half of the expense ratios this one. That is the one knock I found against QQQI. The assets under management are at a nice cool $9 billion. JEPQ is somewhere over 30, it's the oldest, and then GPIQ is 3 and change, I believe. So it's on the middle of the popularity of the big three, and really, in my opinion, the only three that are worthy of tracking the NASDAQ 100. And it doubles down with that simplicity for the covered call strategy it uses. QQQI writes covered calls on the NASDAQ 100 index itself, not the individual stocks, and not through ELNs or structured notes like JEPQ. These are pure index options, which means that it qualifies for that 60-40 tax treatment under Section 1256. 60% of the income is taxed at the long-term capital gains special tax rate, while the other 40 is taxed like your ordinary income or short-term gains. Another bonus is that QQQI only overwrites part of the portfolio. You still get the income, but you're not capping the upside as aggressively as most of the competition. Put all of this together and you have yourself a more passively managed covered call ETF that's throwing off a 14% trailing 12-month yield while keeping most of the upside as a holding such as QQQ. And we'll get into more of that stuff later, but for now, let's talk about that juicy cash flow. QQQI Distributions. Covered call ETFs are known for being all over the map on their distributions from month to month. But QQQI does a great job of keeping that cash flowing at a consistent clip. Let's get into that now. As always, we're going to be using Seeking Alpha for this one, and I'm here on our favorite tab, the Dividends tab. And the first thing that stands out is that amazingly juicy, squishy, yummy 14.39% yield. And you can see the growth rates with covered call ETFs. These will be all over the map, generally speaking, if you've been following other ones for a while. They're not like dividend growth ETFs like DGRO or SCHD, where you expect these to consistently grow. It depends on the state of the volatility and the options market and the NAV and other things. There's all kinds of things that trickle into it. But anyway, the trailing 12-month is slightly up 1%, and then it's not old enough to have a 3, 5, or 10. It's paid dividends for a year. It's grown them for a year, so that's solid. What's nice to see, though, when I come out here to the dividend yield, is the yield trends. So it's ramping up. It doesn't have a trailing 12, so it's only 3, 4 months old, 5, 6, 7. So kind of ignore these, but you should be ramping up even-ish. It is. And now you get up here, you got up to 16.2, fell down a bit. So I'm just scrolling along here, and I'm seeing that it's anywhere from about 13 to 15%. So that's pretty good consistency. And a better way to view that, I think, is the dividend history tab. We're on the 5-year chart, which again, this is gonna be all of it. It's only here to early 2024. But you can see we're going at 59. I won't read them all, but 59 to 62, 64. You do dip down on some crashes here to 53, but 64, 63, pretty solid across the board. And we've dipped a little on the last one at 61. But really anywhere from 59 to 64 with one smaller outlier of 53. But when you compare that to something like JEPQ, which I pulled up here, and I'm on that same dividend history tab, I went to 3-year because it does have more data. I want it more apples to apples. So we're starting somewhere in here. You go from 39 to 34, and I won't read them all once again, but you're all the way up to 56, 55, and then all the way down to 45, and then up to 62, but then you drop to the low 40s and 58. I mean, it's just really all over the map by comparison to QQQI. Now, I did have JEPQ before I had researched QQQI, so I did track along with these as they happened, but one thing I noticed with QQQI, besides the many other benefits we've discussed in this video, is that the dividends just consistently flow in a lot better with that one. The consistency of the cash flow paired with that high yield makes a powerful combination when you combine this with a dividend growth ETF such as SCHD. You can customize your own blend of yield and dividend growth by mixing the two. But the best part of QQQI isn't that yield, it's the tax treatment. The 60-40 tax treatment is nice, but ideally, it won't even come into play. For my QQQI holdings, 99.6% of the distributions in 2025 were classified as return of capital. The other 0.4 was qualified dividends. That's right. I paid basically $0 on thousands of dollars of dividends. But here's the kicker. I will never pay taxes on that 99.6% that was return of capital that went directly to my pockets. Return of capital isn't taxed in the year you receive it. Instead, it lowers your cost basis. And that gives you control of when you pay your taxes, if ever. And the threshold for paying 0% taxes on long-term capital gains is very generous. In 2026, if you're married filing jointly, the top of that 0% tax bracket was a whopping $131,100. And that is including the standard deduction. In my case, with my Roth strategy and a few other things, I will be well below that in retirement. My plan is simple. At the end of each year, I'll sell enough QQQI to realize the gains up to the top of that 0% bracket, and then immediately buy it back. That resets my cost basis higher without triggering any tax. For a lot of people, including me, the return of capital snowball effectively turns QQQI into a tax-free income machine in retirement. The tax treatment is incredible, but none of that matters if the ETF can't perform. QQQI Performance. We don't have a lot of history to work from when it comes to comparing QQQI to its peers. But we already looked at the long-term history of the NASDAQ 100, and we've learned how the simple strategy works. So now the question is it driving the results that we expect? I'm going to break this down in a few different ways so that I touch all the bases. In the first one, I'm just going to strictly compare my favorite NASDAQ 100 covered call ETFs against one another. And then we'll get more advanced with this though, to the indice and other things. Starting out here on year to date, we can see that JEPQ, the orange bar down there, has actually done the best when they're all down at negative 1.21% total return to QQQI's negative 1.5% and GPIQ's negative 1.7. Now I have read for a while about these, just about a year or so, and supposedly JEPQ is supposed to do the best when the market's down. So it is kind of refreshing to see that play out. But you never know what reality is going to throw at you, even when you're done with all the theory craft. But when you scooch it out to 1 year, you can see that JEPQ does fall behind. And actually, GPIQ has done a really good job in the last year at 25.75% to just under 23% of QQQI to a cool 21.69%. Very nice. Of JEPQ. Now, we can't go out 3 years. You can see these are just too new. But what I like to do here is grab 1/30/2024. I put in the total returns from 1/30/2024 through today, which is 3/9/2026. And you can see here that I'm just showing you they're all 130 here. It looks like GPIQ is number one here at 41.49. That expense ratio being 35 basis points, I think, on the gross, is really making a difference over time against QQQI. When you let a couple years play out, that'd be about 1%. and it looks like it's up by just over 1% to 40.5. And JEPQ is at 37.43, not too bad. But you got to remember, JEPQ's dividends are 90% ordinary. That really hurts. And the ceiling is a lot lower, and the dividends are all over the map. I just don't think it competes, to be frank. And then GPIQ, I really like it. The return of capital has impressed me. I am researching this one, by the way. You might see a little mix in my portfolio again. So what happened was I had GPIQ and QQQI when I left my job, retired, needed some income. And then I had read that the return of capital is much stronger on QQQI. So that scared me away from GPIQ. I've been watching it from the sidelines, but I did own a little slice. And it was actually a return of capital of like 94, 95% compared to the 99.6 of QQQI. So it fell short, but anything above 90, I have my eye on. So with this performance, its expense ratio, I don't quite like the methodology. I won't get into all that in this. Like the option strategy, I think is the best and the most basic with QQQI, but I may sprinkle in some GPIQ eventually. It is a very quality option. I like it significantly more than JEPQ at this point. But these are the three. But now I'm going to get rid of QQQI's friend and see how it's done against the underlying index. Okay, I've pulled up QQQM, which I think is the best way to assess the investing option of the index versus the covered call on that index. And you can see here, this is exactly what we would expect. On year to date, QQQI is down less than QQQM. I'm sure most of you are aware with covered call strategies in general, you lower your ceiling and you raise your floor because when it drops or goes sideways, you get that premium income. So QQQM will drop the full 100%, whereas QQQI will only drop by the same holdings, but a lower percentage because some is tied up in those options, which produce income for you in a falling market. So this is exactly what you would expect, but really QQQM will shine over time. If you're not in retirement, by the way, if you're accumulating, go with QQQM or VGT. Do not go with QQQI if you don't need the cash now. I, along with other retirees, need this cash. Because when we zoom out to 1 year, we're still hanging pretty tough. And again, this is about what I expect to see. I always do these live with you guys. I don't pre-look at this. But QQQM is up 26.44% over the last year to QQQI's solid 23%. We caught most of the upside, and we started better here. The orange is a little better because it's a falling market. But then as things go up, QQQM is going to rise more. It gets way up there. You're up 8% right here. But then the market falls and it closes to 5.5%. That's exactly what we would expect here. Bigger ups for blue, better downs for orange. Now I'm going to punch in the total time duration, that 1/30/2024, to see how we've done. Okay, we have the results from 1/30/2024 for each. And this is encouraging, actually. These dropped markets really help us. You can see the blue bars higher here and lower here. That ends up being a big deal over time when you damage control. But QQQI is up a remarkable 40% to its indices 43. So if I got these return, and this does include the expense ratio, by the way, that nasty 68 basis points is baked into these numbers. So that doesn't hurt you in addition to these. That is all in this. So I lost 3%, but I gained 14% yield that I've been able to reinvest in my core portfolio along with cash. I'll take it. Oh, and by the way, you pay taxes on QQQM's dividends. As we discussed earlier, we do not pay taxes, at least in my case. Tax gain harvesting, you can never pay taxes on QQQI if you're in the right situation. Okay, now we're getting into the absolute kicker. You could see I have VOO, my favorite single investment, one ETF investment that exists. It's also Warren Buffett and many of the smartest investors in the world's favorites. But something interesting happens here with VOO and QQQI. Now we know that the NASDAQ 100 has a higher ceiling and lower floor than the S&P 500. But this weird thing happens when you cap the ceiling of the NASDAQ and you raise the floor. It weirdly mirrors VOO. This is that tidbit I've been teasing. Because VOO is one of my favorite investments, but if you look here, year to date, they're about tied, and they trend together. But let's zoom it out. That can't keep happening. Wait a minute. Over the last year, QQQI is up a bit more, 23% to VOO's 20.5. But look at these bars. That cap ceiling and raise floor awkwardly make something that is pretty close to the S&P 500. Okay, and now I dragged it out to that custom date range from 130. That's all we have with QQQI. And you can see the market wins by 0.5%. Look at these bars. You get these market-like returns tax-free forever. And at worst, you're tax-free in the current year. You might have to do long-term capital gains if you have a lot of net worth in retirement. But like in my case, tax-free forever to mirror my favorite ETF and the one that you're supposed to invest in if you're prudent, and to get 14% cash flow during this ride is blowing my mind, but it's also early. So I'm trying to calm down here and not get too excited. But I think that with these two well-established indices, this trend of balance of close returns, maybe not perfect. One of them might get ahead of the other a little bit, but I think this is going to stay, and we'll see. We'll retouch on this in the coming years, but I'm loving these returns, this cash flow, and this tax situation. It kind of just doesn't make sense. It's mind-boggling, but you know what? I'll take it. So far, so good. This thing is clicking on all cylinders, and I am excited for the future. Looking ahead. I've been really impressed with QQQI in the short time that I've held it. It has performed better than advertised across the board so far. I'm genuinely excited for another year of adding to this thing and paying the bills with what is essentially tax-free income that performs on par with the S&P 500. It's still hard for me to wrap my head around the idea of never paying any taxes on the income in the current year or in the future years, but the numbers check out. And as always, I will be the first to let you know if anything changes with this stuff. Before we go, a huge shout out to you amazing channel members that are 34 strong. I can't say thank you enough. You genuinely make these videos possible and inspire me. And particularly in this one, a shout out to my newest member, Ricardo. I appreciate you. Before you close this video, let me know your favorite cash flowing ETF in the comments below. And also, check out one of these two videos to continue down your path towards financial freedom. Remember, money is overrated. Freedom is not. Thanks for watching. Have a wonderful day. And I will see you in the next one. Peace be with you.